Hey there, welcome into another episode of Great Quarter Guys, the show where the lines between freight, finance, and tech are none. I'm your host, Andrew Cox, Senior Retail Analyst here at FreightWaves. This is episode 77. I am alongside Lead Economist Anthony Smith. For the first few minutes of the show, we actually got a very special show for you today. We have a bunch of guests. We're going to have CEO and founder of FreightWaves, Craig Fuller, on in the middle of the show to talk about the Knight-Swift acquisition of AAA Cooper. They are getting into the LTL business. This is the biggest carrier, truckload carrier in the country, getting into the LTL business, so a very big deal, over $1 billion in this acquisition. We're going to get Craig's thoughts. He likes the acquisition, and we're going to see why he believes that not other carriers are going to follow in Knight-Swift's footsteps. So that'll be very exciting coming up at the 3:10. But before that, we've got Rick Helfenbein, who is a veteran of the Great Quarter Guys show. He's been on with us a few times. He is the former CEO and president of the American Apparel and Footwear Association. He's also a retail industry consultant in New York City. And we are talking about Bangladesh. Bangladesh is one of the major manufacturers of American apparel and world apparel, really, and they're having a terrible COVID outbreak right now, the most severe that they've had since the pandemic began. They just implemented a very severe, strict lockdown last Thursday, where a nation of 170 million people were ordered to stay at home for a week. Rick, thanks so much for joining us.
Hey, it's great to be with you guys. I'm sorry I seem to pop up every time there's a problem, which there's been no shortage of recently. The Bangladesh situation is particularly serious, obviously, for the people of Bangladesh. As you said, Andrew, 170 million people, but only 5 million are vaccinated. And, the last time they shut down for a month. So this time, you have two things going against it. One, it's not the alpha version of COVID, it's the delta version, which is more contagious. So they were going to shut down for a week. Yesterday, I think they extended it for a second week. In terms of our industry, the factories remain open. The ports remain open. But can people get there to work? And that's kind of the problem in a nutshell. And then you would ask me, well, how important is Bangladesh, in terms of holiday shopping or in terms of retail in the United States? Well, as everybody knows, we've been having a fair share of issues with China. And China is 37% of the U.S. market in terms of imports, in terms of apparel. Vietnam is number 2 at 16%, and Bangladesh is number 3 at 8%. So there you go. You got 61% of the market tied up in 3 countries, and Bangladesh is a growing and important player.
So Rick, I was just going to ask you, I had seen that throughout the pandemic, at least, Bangladesh had actually gained some market share from China in the apparel market, and that was in part due to the resilience of their industries, the resilience of their importers. You told me that the factories are still open and the ports are still open. Can you just talk to me about the situation there? Because you look at Wall Street Journal and they'll tell you that it seems that the whole country shut down. So it just seems like differing narratives here. So what is it like in Bangladesh right now, at least from your perspective, your channel checks that you've had?
Yeah, from what I'm hearing, we're operating, but the stool's got like 3 legs, but they are sitting on it. It's just problematic. Things have slowed down, and it's a time of year where you actually want to speed things up. The port in Chittagong has delays that are unrelated to COVID or partially related to COVID. There's container shortages. On some of the short haul carriers, there's backup. They can't get the containers back. So maybe the factories can continue making the product. Maybe they'll get that reasonably up to speed, but then can you ship it out? And then Andrew, and I assume Anthony would be part of this. What happens to the economy of the United States? Well, when do you ship goods? Normally holiday, our biggest season of the year, which we're planning on being up, say, 6 or 7% this year, as the big comeback in retail. When do we ship goods? Well, we ship goods in the old days to arrive like the 1st of October. You don't want to push it too soon. You don't want to push it too late. But because of the delays, everyone's looking for September. So when do you pack up a container from Bangladesh to get in there in September, like now. So there's some concern, and I can understand why Wall Street would be concerned. It could rattle a few cages. It's too early, and I want to emphasize it's too early in the process to say there's a problem. But everybody should be aware there have been many problems, and this could, just be another one.
Yeah, I mean, it's certainly not one thing here that's holding back the industry. I wanted to mention this quote from Brooks Running CEO Jim Weber. He was on CNBC's Squawk Box on last Tuesday, and he said his company is running on roughly an 80-day cycle for shipping compared to what used to just take 40 days. Is that widespread across the board? Are you seeing, the people that you work with, are they seeing delays of that kind of nature, double the normal shipping time?
Yeah, not necessarily double, but delays. I mean, some people have moved some goods to air. There's been a lot more strategic planning. Everybody's set up war rooms on freight. I mean, when have you had a war room on freight? So, the concerns are there. People have bumped it up. And if you ship, Andrew, if you get that ugly Christmas sweater the day after Christmas, it's not as valuable as it was before. Same thing with Easter bonnets. Same thing with golf shirts for Father's Day. So, you try and time the market. You think it's going to be good. You put a lot of emphasis into buying product to make the numbers for holiday. And, you got to pad that with shipping. So people have moved the dates up. The guy from Brooks is totally on target.
So, Rick, one of the things I'm curious about when we're looking at all of these movements right now in the supply chain, I mean, of course, production's one part of it, the backlogs is one part. What are your anticipations with new orders still kind of coming in and pushing through on this side of the economy, on this side of the industry, as we're still seeing that there's such a backlog that we're struggling right now with inventories? What do you see on the new order side, just kind of throwing another wrench in this entire equation?
Well, it's a really good question. It's a little more complicated because new orders are coming in. People are trying to get back on their feet. They're able to get financing, which was a problem a year ago. So they got the money. They want to buy the goods. They're balancing how they purchase more, trying to move more from China, frankly, into Bangladesh. Not for the reason that's apparent. A lot of it has to do with the situation in Xinjiang and the concern that, of cotton. So they want to get different cotton. They want to put it in Bangladesh. They want to make sure they don't get held up at the border coming in for being, suspect of product from Xinjiang. So there's a lot of dynamics going on all at the same time, and we will soon see how this plays out.
So, Rick, you said it's a little too early to call it a problem. At what point would you consider it a problem? Like if we see this continuing if the Bangladesh has another, 2-3 month type of lockdown, is that, at what point will you start to get really worried about the Christmas holiday season?
If we go past 3 weeks in the lockdown, I think alarm bells should start to ring. 2 weeks we can probably manage. 3 weeks, I don't know that we can. We will see. Time will tell. And all your freight guys that are watching this, we kind of need your help right now. America's counting on it.
Yeah, certainly so. All right, Rick, thanks so much for your time today. We'll be seeing more of you shortly. Hopefully next time we talk about a good thing happening. You do seem always to come on in a little crisis management mode.
Yeah, well, I'll look forward to that. Thank you, Andrew. Thank you, Anthony. Appreciate it.
You're welcome, sir. Have a good one. All right. So let's do some charts of the day. We each have a couple here. One on consumer spending, another on just a truckload capacity. So let's go ahead and go through the truckload capacity. And this is a good transition to the segment that will come after when we have Craig Fuller to discuss this Knight-Swift acquisition of AAA Cooper. I gotta say, I kind of stole this chart of the day from Craig's Twitter because it opened up a good conversation that I want to speak to. So this first chart of the day is the for-hire total count of tractors that we have from the FMCSA. Basically, Craig was speaking on the narrative of a driver shortage and how it doesn't, aptly describe the problem in the market right now. That carriers are adding capacity. Capacity is up 2.6% year to date, but tender volume is up 13% year to date. We simply have demand growth outstripping supply growth. And there's a couple things that are at play here, and one that I wanted to mention is that I'm not here to pontificate upon immigration policy, but it's certainly having an impact. So if you look at some of the immigration data, so only 130,000 non-citizens obtained lawful permanent resident in Q4. That's down 78% year over year from fiscal year 2019. 17% of all drivers are Hispanic, 15% of drivers come from other countries beyond that, so a third of all drivers are typically immigrants. Immigration has a big point here. You look at South Florida, we've had tens of thousands of people move from New York and from California to South Florida, yet if you look at the population in South Florida, it's actually down compared to pre-COVID, and a lot of that is due to immigration. So just to make a point here that carriers are trying to add capacity. That is happening, but there are many factors at play that are restricting the amount of drivers available, including the Drug and Alcohol Clearinghouse, including driver training schools not being at full capacity. It'll take some time, that's all. All right, Tone?
So real quick, my chart of the day, of course, got to look into Sonar and look at personal consumption expenditures for durable goods. And of course, our van outbound tender volume index. And so looking at it, of course, there has been an increase in durable goods for consumer spending throughout 2020 going into 2021. And we see how much that's contributed to overall freight volumes going throughout the year. The other big thing that we're looking at in the most recent durable goods report was that there was a slight tick down for durable goods. Nothing too substantial, but notable overall. The other big thing, looking at overall consumer spending, it was flat, 0% movement. This is kind of big news because there was not any kind of stimulus kind of influx or into the economy at that moment. So we're looking at that, that's still showing that there's momentum despite the lack of any type of new stimulus packages being pushed out. Again, that flat movement isn't nothing to kind of sneeze at because when we look at the previous month, it got an upward revision to 0.9% from that 0.5%. So it's still showing that consumers are still active, and that's going to hit more freight volumes as we continue to see durable goods feed into it, of course, services playing a role as well. But we are seeing that consumers are spending, and of course, there is substantial savings still in their pockets.
Yeah, that's right. Good spending, flat month over month, still up 20% compared to February 2020. Services spending is about flat. I think it's at down 1%. So really strong good demand still, even though it's flatlining here right now. All right, perfect. All right, we now have our CEO and founder, Craig Fuller, on to discuss the Knight-Swift acquisition of AAA Cooper. Craig, this is your first time on Great Quarter Guys somehow, so welcome to the show.
I think I've been on most of the shows, but this is the first time I've been on Great Quarter Guys. You know, we need the spinning chairs, you know how Saturday Night Live, they sort of zoom you in, that would be pretty cool.
That would be pretty dope. Yeah. All right, you like this acquisition. Why?
I love this acquisition. So the company is AAA Cooper, the Knight-Swift, which is the largest truckload carrier in the market, has purchased AAA Cooper, an regional LTL carrier that serves the South and Midwest. And I think it's a significant transaction because it moves Knight-Swift into the LTL business, a business that they have not been a part of in the past. And so it's an unusual transaction only from the perspective that truckload carriers have historically not purchased LTL businesses. This is a big diversion from that model.
And you don't believe others will follow?
I don't. I think Knight-Swift is uniquely positioned because of the strength of their balance sheet, their large scale. They've proven with Swift, acquiring Swift a couple years back, they can integrate two very different operating businesses and do it successfully. With the purchase of AAA Cooper, LTL is obviously very different than truckload. Putting those together on surface seems like an odd transaction because we haven't seen large truckload carriers do it, but I actually applaud it. Now, TransForce did something similar when they bought UPS Freight a couple of months ago, but I think the way I think of TransForce is very different than the way I think of Knight-Swift. Knight-Swift is an operator first. TransForce more operates like a private equity fund, or even some could argue an ETF of transportation, of freight, trucking, transportation assets. Whereas Knight-Swift is an operator. And so they certainly will take an operating position in this business, being a wholly owned subsidiary. And there will be a lot of synergies for customers. I mean, you think about the scale of Knight-Swift, it's now I think an $8-9 billion company when we look at the full sort of strength of it. It's a big business.
Yeah, this is not a small acquisition, right? We got 70 facilities, more than 3,400 doors, 4,800 employees, 3,000 tractors, 7,000 trailers. I wanted to talk to you about the criteria that Knight-Swift said in its search, right? So they said they wanted significant market share, profitability makeup, and a management team that could operate independently, right? That's kind of following their model. You expect them, how much do you expect them to integrate here? They expect it to operate kind of independently. They want the board to, I can't remember the CEO's name from AAA Cooper, but he's now on the board of Knight-Swift. What are your expectations for the dynamics between these two brands?
Well, I mean, LTL is a very different business than truckload. Truckload is, for hire services or dedicated services, which are buying full truck. LTL is obviously, I'm buying a position, a pallet, or buying a weight-based movement. So it's a different business. Terminal operations are quite different than truckload, over-the-road truckload. Now, Knight, their model is truckload, but tends to be around these sort of super regions where the trucks do come back on a regular basis, versus Swift, which runs the over-the-road and for-hire market. But LTL is still a very different animal than what truckload is. It does open up the opportunity for Knight-Swift to serve a different set of customers. Typically, customers that buy in truckload are larger scale, whereas the LTL business tends to have more mid and small size shippers that take advantage of doing it on a per weight basis. So it'll be a different model. Now, I think they'll run them predominantly separate. There'll be some executive management oversight, and I could see Knight-Swift running some of the line haul operations between terminals. There's probably some advantages in procurement of buying trucks and maintaining those trucks, as well as tires and fuel. But beyond that, I think it's going to have to be an entirely different operations team. One thing I would point out is the CEO now has $1 billion in cash and equity in the bank. How long do you think? He says he's going to stay on, but you got $1 billion in cash. Your salary is say $2 or $3 million a year. How long do you really stay in a role of running a trucking company? No offense against trucking operations. It's a tough business. Just seems like with $1 billion of cash that the question would be, how long does he stick with it?
Yeah, it's certainly a good question. I wanted to ask one last thing before I let you go. It seems that Knight-Swift got at least a decent deal compared to some of the public market valuations of the best LTL carriers. You're looking at you look at Old Dominion and some of the best, they're trading 15, 16, 17 times. They paid less than 10 times EBITDA for this company. Is this you think that's based on the fact that they're running a little bit higher OR than some of the best run carriers? What are your thoughts there?
Well, I think you have a public-private delta in terms of public companies have a higher multiple. You mentioned Old Dominion, but we can name the big public companies. They all are significantly larger than what AAA Cooper is. So that's one reason you see a delta or an advantage of being public. It's easier to get financing in public markets, which gives you a premium versus private markets. You do typically see a couple turns above it when you have except maybe in venture, the world we live in, where private companies may be valued higher than public or historically. But in these sort of large established industries like trucking, you will see a pretty big delta between valuations. The other thing to keep in mind is that AAA Cooper was a regional carrier, whereas even Old Dominion, which has historically been sort of a super regional carrier, has a much larger footprint and, frankly, turns and multiples in revenue versus AAA Cooper. I mean, AAA Cooper is a really nice business, but it's not for most people, a sort of tier one household brand versus some of the other big LTL players like an XPO or UPS Freight or even Arkansas Best or Yellow Roadway. So it is not a tier one type transaction, but it is a significant player. I think the more interesting story is what does Knight-Swift do with this business after they have it. I would suspect they're going to grow it quickly. And because of the tightness of the LTL operations, they should have the opportunity to do that. One of the things to really watch is, as you mentioned, the cultures and how they sort of integrate that business into their existing operations. But I would expect big things from it. One of the interesting sort of side stories on this, Andrew, is Jerry Moyes is the CEO and owner of Central Freight Lines, a Waco, Texas-based LTL operator who happens to be one of AAA Cooper's largest competitors. Jerry Moyes owns 5.4% of Knight-Swift stock. Remember, he was the founder of Swift and was involved in a number of transactions at Swift, merged into Knight-Swift, and now is one of the largest shareholders. What do you think that dynamic looks like?
Well, I don't know Jerry Moyes, but I can imagine. I mean, what do you think? He had to have had a say in this deal, right? At 5.5%.
I don't believe he's on the board.
No? Okay.
And if you're not on the board, and even if you're on the board but you have a minority share, you really don't have a lot of say in sort of corporate operations. I mean, the only thing he can do is vote with his shares, which would mean he would have to cash out. But I don't think he has much of a voice as it relates to these big strategic moves.
I wanted to ask you one thing before, this is the last thing before I let you go. So CEO Dave Jackson, Knight-Swift CEO, he said, I couldn't be happier to finally find the right time for both of us to create a partnership. What do you read through that? Do you think that this has been an ongoing thing and they've just kind of waited for this to happen? What do you make of the timing of this happening now?
Well, Kevin Knight, when they merged with Swift a couple of years ago, had said that by 2020, they were going to be a $10 billion company. I think the sort of volatility of the freight market between what happened in 15 and what happened in 18 or 19 and then COVID probably delayed their ability to do these big acquisitions. Valuations have been weird for the last couple of years. I think now that we've seen stability in the market, Knight-Swift stock has held up really well. They got downgraded significantly, at least in terms of share price, during that run from 17 to 19. Now it's stabilized. There's a lot of confidence in the trucking market going forward. So it's probably put Knight-Swift in a position to make these bold moves. But one of the things really interesting about this is they bought an LTL carrier. They could really buy almost any truckload carrier, really pick almost any truckload carrier for that matter. And yet they chose an LTL carrier. That, I think, is a signal for a lot of the for the truckload operations, is that maybe from a Knight-Swift perspective, it isn't as desirable to buy a truckload operator at scale than it would be to move into an entirely new business. It's very interesting, I think.
Yeah, I think it's fabulous. And I think just thinking through the last year with e-commerce and the way that retailers have started to use their stores, shipping from stores, fulfillment from store, it creates the necessity for smaller and more rapid replenishment at stores. That builds into LTL. I mean, John Larkin's been calling this since 2018 that LTL is perfectly positioned to gain from this e-commerce growth.
I love the LTL business. LTL doesn't have the commoditized pressures that truckload does. It has more pricing power. As you mentioned, it serves the e-commerce market quite well. I do think it's a message for truckload operators that it's just hard to justify big acquisitions in that space versus LTL. I think it's a really smart move by Knight-Swift to get to that $10 billion mark without having to sort of buy into a market that they're already well positioned for.
Yeah.
But I think it says a lot about the truckload model. And we've seen transactions, Brad Jacobs at XPO sold off their truckload business, CFI, because they couldn't make the model work. And if you're an acquirer like Brad Jacobs and Knight-Swift and you're not making these big moves in the truckload market, I think it's more of a signal at how difficult that market is versus these other alternative markets like 3PL services or LTL.
Said earlier you're expecting them to expand this business quickly.
I would think so. I mean, if I were, and look, I am not Kevin Knight or David Jackson, and I don't want to pretend to be. They certainly know how to run a trucking company much better than I do. That's why I'm those that can't teach or show up on TV. So I won't pretend to be them. But if I were in their shoes, the thing that I would do is you have access to a lot of capital, access to a lot of resources. And really the customer base, I imagine, is quite different. Knight-Swift has a lot of large-scale companies and customers that probably not a ton of overlap. And so they have the opportunity to take their network of clients and expand offering LTL services or door-to-door services with the brand. And then also, let's not forget the 3PL component. Knight-Swift is a big intermodal operator. Knight-Swift is a big freight brokerage, has a significant scale 3PL business. So I could see that being a really nice complementary part of AAA Cooper's business going forward.
Is there anything that you know, this is obviously an opinionated question, but is there anything you could see that would stop them from being able to replicate their success with previous acquisitions and bringing down OR, integrating the business? You know, or you know, this is a good team. They've done it time and time again.
Team, but anytime you have an acquisition, you have risks. You have personality risk, you have cultural risk, you have operational risks. But they have a track record of doing it, and I think a lot of people doubted them when Knight and Swift merged. There was a lot of doubt on whether that would be a success. I think the jury has proven that the Knight Swift team knows how to execute this really quite well, and you know, I would suspect that they're going to bring a lot of sort of operational excellence. I would think we'll see some improvements in line haul services for AAA Cooper, just because truckload operators tend to have a little bit better sort of more optimal the way they think about it, this line haul equipment. But I don't think we'll see significant quote unquote operational improvements. Where I would expect it would be in terms of growth related to customer acquisition and their networks. That's where I would think you would see the biggest sort of, and then so if you're Knight Swift and you're David Jackson, you're making significant investments in your customer acquisition services and trying to expand your relative customer base versus trying to create operational efficiencies. From what I can tell, what limited information we have about AAA Cooper, they look like a high-quality operator running a nice OR. So it doesn't suggest that there'll be significant operating improvements is sort of the thesis of the business. As you mentioned, there's a lower multiple paid for AAA Cooper, but more importantly, I think the expansive customer base is where the value is.
All right, Craig, thanks so much for joining us.
Thanks for inviting me today. It's fun to be on Great Quarter Guys. It's one of my favorite shows, but we hope to see you again, Andrew.
Yeah, definitely so. We'll have you back. All right. All right, team, so we only got a couple minutes here, so we're going to bring Anthony back on to talk through. We've got one You Care or Not today. It is an economic one. We got some data from the University of Michigan. We got their Consumer Sentiment Index for the month of June. So they always do a preliminary reading, and then they do a final reading. So we got that final reading, and it came in at 85.5. So that is a fall from the initial reading of 86.4, but it is higher than May's 82.9 figure. Anthony, this is only 1 month of growth, but what are you thinking? You care or no?
No. It's not too much of a substantial decline, and it's still moving. I mean, overall, still in a good place. Also, real quick, you got a compliment from Craig on being one of your favorite shows. You've never said it about Freightonomics, but I'm not going to hold it against you. But anyway, looking at that consumer confidence number, I don't care too much about this slight downward movement. There are too many things building up in the right direction. We're looking at overall employment, speaking of which we get job opening numbers tomorrow. We also seen new pandemic lows on initial jobless claims. So there are too many things moving in the right direction for a slight blip down in that number to really be too meaningful.
Let me stop you, because I got to ask. It seems, okay, so we look at the Consumer Sentiment Index. We look at consumer spending for the month of May and June. It seems that economists are feeling that most of the growth we're seeing right now is from higher income earners. So if you look at the University of Michigan came out and said all of the June gain was among households with incomes above 100,000. And if you look at the consumer spending data, in household incomes above $200,000, they are really pulling the economy up, which is actually a trend reversal from during COVID, right? During COVID, that additional stimulus we had, it was actually the lower income earners that were kind of lifting the economy and spending more relatively than the higher income earners. Is that something we should be worried about? The fact that lower income earners are not spending, they're not as optimistic as the future as high income earners?
I think it should be something to be concerned about if we don't see. So the things I've been hearing on middle to lower income earners have been, well, of course, they're not going back to work because why would they want to go back for these wages, all these other things. And so I think what we're going to see potentially, or what we should see, is slight skills, differentiations, more development, things like that, because those are going to be the things that set a lot of people apart, as in addition to getting back into the workplace earlier than others. So I think that is going to be an area of concern. But the bigger thing is going to be, how do these lower income individuals differentiate themselves on a skill set basis in order to kind of position themselves to be a little bit more higher valued in the marketplace right now. But that is a concerning trend, especially when you're looking at wage gaps and things like that. But I definitely do think now would be the time, if any, to really parlay any new skill sets.
Yeah, that's a good tip from our lead economist, Mr. Anthony Smith. That is unfortunately, we've got all the time today. We packed it in with two big interviews with Mr. Helfenbein and, of course, Craig Fuller. So that's all we've got for today, episode 77. We'll be back with another big show next week at 2 o'clock. We'll see you then. Peace.